Good afternoon, everyone. Thank you so much for joining us today for our webinar on Introduction to Group Captive Insurance. Thank you for taking some time out of your day to learn about something that we're very excited to talk to you guys about with John McHale and Eric Hausman. We've got a lot to get through, so I'm just going to do a very quick reminder about how our webinars work, and then I'm going to toss it over to Eric Hausman. So as a reminder, this webinar is recorded, which means that you will get a link to the recording after the webinar is done, as well as a copy of the presentation slides. This webinar is also going to be very conversational in nature. So we will have the Q&A and chat active for any questions you have during the webinar, and we'll stop once we see that question and we'll answer it directly. With that, without further ado, here's Eric Hausman.
Thank you, Cassie, for kicking things off there. To give you guys a quick overview of today's webinar, this will be an introductory high-level conversation around captives. So we will be touching on some of the benefits of an unbundled approach to purchasing your insurance, the basic structure of a captive, eligibility criteria, and how they function, as well as some of the benefits that our captive clients have realized over the years. For all of those of you who are not as familiar with Hausman Group, we are a top 100 property and casualty agency in the United States, headquartered here in Wisconsin. And we pride ourselves on providing comprehensive risk management and employee benefits solutions and going beyond the traditional insurance brokerage relationship. As Cassie said, we do want today's webinar to be extremely interactive. So if questions pop up, shoot them over to us. I'll be monitoring those today as John McHale is running through the meat and potatoes of everything. So please do send those over and I'll interject at those points. I would like to now introduce John McHale from Captive Resources. Captive Resources is a company that we have partnered with for quite a while. They bring 40 years of industry experience to the table and are one of the premier consultants to captives that are member-owned throughout the United States and offer the full suite of services to support their captive groups. So that being said, I'm going to introduce you to John McHale. He's going to get into the meat and potatoes and can tell you a little bit more about Captive Resources and how they operate.
Yeah, first of all, thanks for both Cassie and Eric getting this set up. Again, we much rather have you guys ask questions if it's easier or you're more comfortable shooting that via the email to go that direction, because we've got both Cassie and Eric kind of fielding those questions as they come in, and I just soon answer them as they come in. But again, a little bit more about my company. I've been there 26 years, which is why I have so much gray hair, but we've been doing this for 40 years. We've got 45 now. What we call member-owned group captives with over 6,000 members, roughly. Actually, we're approaching $5 billion in total premium amongst those various programs. The nice news for our members, or what we call shareholders, is that over $4 billion has been distributed to them since the company has started. The beauty of a captive is you're becoming an owner. So you get the same perks, just like an insurance company, where when you have those good or average years, you're getting a good chunk of that money back. So that's where the $4 billion in distributions comes from. The other nice thing about having that kind of size is that we figured out pretty early on that it would be much better to bulk together all the captives when it comes to the investment side. And that's what we did back in 1994. We set up something called the Captive Investors Fund, which is that last bullet there. It's over $9 billion under management right now. So all the various loss funding that you have an opportunity to get investment income back on is all grouped together, which attracts very good fixed income and equity partners. To date, its return has been about 5.5%. Again, so your money is going to continue to work because the dividends don't show up a day after you join a captive. For most captives, 3 years down the road, you start paying partial dividends. And we'll go through the mechanics on each of the captives or kind of give you a generic captive to go through a model. But generally, about 3 years down the road, the partial dividends start showing up. 5 to 6 years, they're completely paid out for most captives. So again, you're going to get the investment income, which is what the carriers get, which is why a carrier insurance company can underwrite to a loss. They still can make money because they don't have to pay the claims out in a day or a year or 2 years. Normally, about a 5 or 6 year window, especially on anything large or significant. So you're getting those same perks because you basically are becoming an insurance company owner. So again, that's kind of what this definition reiterates. Ultimately, you guys are becoming the insurance company owner. So that provides you much more control over your costs and further allows you to kind of decide who gets in, who gets kicked out, and even on the service provider side, if somebody's not doing what they need to do, you can make those changes too. Fortunately, we haven't had too many major service provider changes, but it does happen because an insurance company can lose their rating, and if they do, then the captive has to be with A-rated carriers, so they can make that change and switch carriers if they need to. Normally, somebody by now has said, okay, or maybe has heard enough about captives to start talking about what's the difference between a heterogeneous and a homogeneous, because most of our captives kind of fall in those two windows or two buckets. So what is a heterogeneous captive? Well, it's made up of a bunch of different companies. So you can have, like this list shows, anything from auto body shop to a fast food franchise, all in the same program. The beauty of that is you can get to much larger sizes. The overall group can grow much quicker. And as you get larger and larger, the captive can take on more risk as well, because what happens is generally the captives start out where you take a limited amount of risk, but as the captive grows and gets more mature, the group says, hey, let's take on more risk, which means that's going to impact or lower our overhead costs and potentially allows us to get more of our money back. So that's kind of the big beauty of a heterogeneous captive, is they can get to much larger overall sizes, and certainly our biggest captives amongst the 45 are in this heterogeneous category. The other type of captive is homogeneous captives. Now, for the most part, these tend to be a little bit more difficult, tougher classes, however you want to call it, where maybe the heterogeneous captive says, hey, I'm not comfortable, for example, doing a roofer. They're going to say, we got to have, there's still good roofers out there, so what do we do? So over the years, we've continued to grow our homogeneous captives, which kind of fall into these three kind of categories, with the majority of them being between transportation and construction. So you can read the slide, you can see a variety of different transportation and construction captives we have. And then we kind of have a miscellaneous program, which runs and does things like staffing, agriculture, healthcare. Actually, the captive that I spent most of my time on is called EDIC, the distributor one there at the bottom right. It's probably the opposite of most of our homogeneous captives, because again, most of them are for tougher classes. What happened in the case of the distributor program is we had somebody in our hetero captive that said, hey, I want to be just with distributors. It's a more preferred class, doesn't have as much risk profile, and that's why we started it. So most of our homogeneous are in tougher classes. The distributor one would be the opposite. It's kind of more of a preferred class.
So, John, one of the questions that was asked is, roughly what's the split between heterogeneous and homogeneous captives out of the 45? And then one other comment, that John touched on that I want to make a point of is the members of a captive, and if you are in a captive, you do have full say over the types of businesses that are joining. Obviously, when you are, coming to the table and sharing that risk, one of the benefits of the captive is you do get to vet those partners that you are sharing that risk with. And it's not only on the front end, but on a continual basis to help manage your risk.
Yeah, I mean, it's a good question. I think it's probably pretty even these days in terms of number of captives that are either hetero versus homogeneous. There's definitely more premium on the hetero side. So it's probably, if I was to guess, probably 60-40, 60% or more in the hetero captives. But we've added so many more homogeneous captives that that gap is not as big as it used to be. But again, that's kind of our job working with Eric and his team. One of the first things that we do when we get a new prospect is figure out which captive makes the most sense, because the other issue becomes as captives get bigger and more mature, guess what? They get pickier. So the members start saying, okay, we're going to bump up our minimum premium to get into this captive. That doesn't mean if you're already in there and you're too small, they're going to kick you out. So everybody gets grandfathered. But as they get bigger and more mature, they tend to bump up their minimum premiums and be more selective, because what I haven't talked about, the next slide shows we are a Cayman Island all of our captives are based in the Grand Cayman. So part of that means that we have to have all of our board meetings out of the country, which if you're a traveler or have other people in your business that don't mind going to some nice spots, it's not a bad thing. But we do have to do any official business has to be out of the country. We do have to get to the Grand Cayman every third year with all of our captives. But basically the membership decides where they want to go, and they typically do 2 board meetings a year. And that's kind of what this slide talks about, a little bit more about the governance. Everybody's an equal owner, 1 vote per member, majority rules. Everybody's basically a board of directors. All the heavy lifting is, done via various committees. The 3 main ones that you typically see are finance, which kind of monitors investments and any payments or outstanding debt, or each year. I mean, we do a financial statement twice a year. So they monitor all of that. There's usually an underwriting committee that looks at who gets in, who should be kicked out. And then there's a risk control committee, which is the ones that set the benchmarks in terms of safety programs. Again, what do they want to cover? What do they want to get the group involved with and stay educated on? Because everybody's kind of in it together, and you'll see that when we get through the model.
So John, one of the attendees has a question in regards to why is that the governance does have to happen outside of the United States?
Doesn't have to. Don't forget, we're like one of the older, or the one that's been doing this the longest, as far as like technically we're considered an insurance consultant. But back when our company started, there weren't options. Today, you actually can do onshore captives. For us, it was kind of like, if it's not broke, why fix it? So we continued to maintain all of our captives in the Cayman, which has no corporate income tax, which is not a bad thing. So when your money is earning investment income and potentially coming back down the road as a dividend, there's no corporate tax on any of that. Now, when the dividends do show up and have to be repatriated back to the U.S., there will be Uncle Sam jumps back in the game. There will be taxes, but there are some ways to handle that. You can either continue to keep it in the company name, but you can also do things more creative, because the preferred shares where all the dividends go, and you can actually switch that to better tax treatment, whether it's a trust or split between the owners. So there's some creative things that you can do, but it really, for us, there are onshore captives. It just really everything was set up well before there were those options. And we continue to use that. Even as we add new captives, we continue to set them up in the Cayman.
Thank you.
Now, this slide may be misleading. We don't know if your costs are going to be lower. I mean, if you have very good losses, above average losses or really low losses, and we're always looking at a 5-year window, then we're going to be very competitive. But depending on where you are in the market cycle, sometimes if you're in the traditional market, you might get a price that you really don't deserve. So depending on how well you're priced and how well your losses are will depend on what our costs are going to be. So I wouldn't go to the bank saying you're definitely going to have a lower quote. Quite honestly, Houseman knows that if we have an account that has a 5-year history where 3 out of 5 years are not very good or not clean or had their share loss experience, it's probably not going to make sense for us. Now, down the road, it still might, but generally, we're looking at above average accounts because our pricing model basically takes care of those that do a good job on their losses and is brutal for those that aren't. Because we're always using an independent actuary. He's looking at a 5-year window. And then once you're in, then you do get some insulation from the market because we've got rates right now that would probably astound a lot of people, especially because auto has seen its share of increases over the last several years. And we still have members that will have decreases from one year to the next because our pricing model is based on 5-year history of the primary piece of it is their own 5-year history. So we get to not only some competitive numbers, but if you're in it long term and you continue to improve your safety and manage your claims, you get to numbers that you typically just don't see in traditional insurance.
Yeah, and to jump in there, that is one of the biggest benefits of a group captive is they're underwriting you specifically as a company. Whereas in the standard market, a factor of that is your specific performance, but at the same time, they're also underwriting the entire industry that you're operating in. So some of that is out of the control of what you're doing from a safety standpoint and claims management standpoint. Whereas within the captive, if you're performing well, you directly are rewarded for that.
Yeah, I mean, it's just back to being kind of in the driver's seat, being a owner. It's almost like owning versus renting. If you own, um, they're looking at just your I mean, the majority of your law premium is based on that. And you'll see that when we get to the model. So again, here's some of the other perks. Again, doesn't have to be best in class, but we're looking for above average accounts. Once you're in, we are going to encourage you. Matter of fact, a lot of the captives nowadays will have travel allocation fees built into your premium. If you go to board meetings, which typically most captives are going to have 2 a year offshore, or you go to the risk control workshop, which tends to be more your HR operations. If you have a safety person, those are going to be onshore domestically somewhere in the US. But they tend to have travel allocation fees built in. So if you go to those meetings and events, then you get those dollars back. And, it's there to have a lot of best practice sharing and gain a lot of knowledge because there is a component where you guys do risk share amongst each other. So everybody in the group wants to, or you want everybody to perform well. And if they don't, at the end of the day, you as a group can obviously kick somebody out, which doesn't happen a lot, but it does happen occasionally. All right, so I'm gonna switch gears unless you got anything other questions there, Eric. This gets a little bit more into the mechanics of how the captive works. We're looking at these coverage lines, workers' comp, general liability, and both auto liability and auto physical damage. So the collision, the parts that get broke during an accident versus the third party exposure. So these are the lines of coverages that are typically in our programs. Most of the captives, unless it's a transportation program, are going to require workers' comp. So that's generally going to be required for most of our captives, unless it's a transportation captive. And of course, in that case, they're going to require the automobile. But generally, you're looking at all three lines in all the programs. Years ago, they used to have property built in and figured out that's not a really good fit. It's kind of apples and oranges. You know, you have things like hurricanes, wildfires, all that is a property exposure. So we do have a sister captive that lets you do property, but it's not in any of our casualty programs. So these are more predictable. Again, when we go to price it, we're looking at their last 5 years of losses. And I'm going to give you a generic captive, one that I work on. It's actually a heterogeneous captive. Right now, their retention, meaning the group collectively, is on the hook for the first 500,000 of every claim. So most companies have workers' comp, automobile, general liability, and all of those numbers get thrown into one bucket, and it's there, or actually two buckets. You're going to see that shortly. But basically, it's there to pay the first 500,000 for every claim. Obviously, if somebody has a really large claim, that's where the risk sharing piece comes in, because other members may have to help out if somebody has a large claim. But essentially, the group is on the hook for the first 500 of every claim. It started out at 250. So over the years, this one's closing in on 30 years. Over the years, they bumped up that retention, again, to take more risks themselves and to lower their overhead costs, but also be able to gain more the reward part of it.
So, John, one of the questions that came up is, the underwriting is done individually, but the risk sharing is based on the group. And you can correct me if I'm wrong. That's the case, but it's also not the case, as there's different pools that you're pulling from in regards to one of the pools is purely your own claims. And then we have the B fund, which is going to be stepping in where that risk sharing comes into place, which we will be getting into in a little bit here as John continues to go through the structure of a captive. And we'll have some claim scenarios as well for you.
Yeah, if you want to, I mean, hopefully they can hold tight, because once we get through these next few slides, then we'll go through a couple, two or three different claim scenarios, because depending on the scenario, to your point, there's going to be different buckets. There's really two different buckets, even inside this, going back to this first 500,000. We have what we call a bucket to pay small claims, and you're going to see that shortly. And then anything over, in this captive's case, over anything over 125 grand is going to, that's where you get help from the other members. So you'll see that shortly. Again, looking at it from 30,000 feet, though, the group takes the first 500. Then we go to reinsurance to take care of this dark blue layer. So anything above 500 up to 1 million, in the case of this captive program, is going to go to the reinsurance company. And actually, there's 3 different reinsurers behind the scenes, but they're there to pay basically the bigger claims, unless it's a workers' comp claim, and then it's really unlimited, which is required by the workers' comp statutory. That's why they call it statutory. You could have a $2 million comp claim. The group would still pay the first 500. The reinsurer would take the next 500 to get up to 1 million. And then we have separate, what we call statutory protection, that takes it to the next limit. And then this is where Eric and his crew help us out, because we also need to place, or have them place, coverage in the, what we call the umbrella or excess market. And actually, this slide is outdated now, because they have now bumped up this captive just recently to $2 million limits. We're starting to see more of the captives going from, at least on the auto and the GL, now going up to 2 million limits. What they did initially was they offered what they called a buffer quote over the million. Later, they also offered it on the GL. Now today, both lines have $2 million limits. So again, it's there because certainly the brokers needed help, and it helps when you, because they're dealing with much increased prices in that excess or umbrella market. So if we can price it as a group competitive, then was the mindset that let's do this as a group. And now it's required that everybody has 2 million limits on auto and GL. Did you want to add anything on the whole excess piece, Eric? Or
No, but I can vouch for the fact that with the captives using their purchasing power in the reinsurance market and purchasing up to that 2 million level versus just having the 1 million of primary, that has helped our clients a ton when it comes to building out that next tower of excess liability. And that was really driven by the current situation in the excess liability marketplace, the continued nuclear verdicts that they're seeing and the pressure from a rate standpoint. It was just, much more efficient for the captives to go out as a group, buy those higher limits, and then individually going out on the excess side to build out those umbrella towers that are required by each individual client that is in the captive. And it goes to show just how the captives continue to innovate and make sure that they're taking care of their clients at the end of the day, within the changing marketplaces that they're operating in.
Yeah, and probably the only other little like sleep easy coverage is this basket and clash, which we don't need to spend a ton of time on, but in theory, you could have what we see the most of is basket claims, meaning let's say you have a driver that gets in a wreck, so you got an auto liability claim, but they also hurt themselves in the wreck, so they got a comp claim. They're not going to charge the captive 500 for the comp and another 500 grand for the auto liability. They're going to basket that together, treat it as one occurrence. So it's basically a little side insurance that we provide over here to minimize the risk to the group. And we also do the same for Clash, which is an English band. No, actually, nobody here on this call probably knows that, but Clash would be two members that maybe had an incident or a wreck. You had multiple members in multiple lines. They're still going to treat that as one occurrence. So the most the captive has to ante up is 500 grand. Now, the one member that might have been more at fault could potentially pay a higher portion of the 500, but it just minimizes the risk to the overall captive. So you don't see Clash as much, but it has more potential for problems. It's just built in Sleep Easy insurance. So this is kind of the captive from 30,000 feet. We talked about how we do still split up this lower bucket between two different layers. So that's what this slide gets into. So what all the captives do is they end up coming up with what they call a frequency layer or a fund bucket. And it's there, if you can read the print, in the case of Summit, which is the model we're using, it's there to pay any claim from 0 to 125, whether that's workers' comp, auto, or GL, assuming they have all three lines in the captive. In the event you had something more exciting that exceeded 125 grand, then it would leak into the B fund, which has got a much smaller bucket. It's a much smaller number when they go to price it, because what happens is in the B fund, if you had a big claim, it's going to go from 125 to 500. But if you don't have enough money, that's where your other friends come in to help you out. So on a larger claim, and we'll show this with one of our examples, you're going to get some help from your friends if you have a big claim up in that second layer, because normally your B fund bucket it's not real big, and it's not going to go real far, so the other members end up helping out. So bear with me, because I'm going to throw some numbers at this and actually go through three different examples. Obviously, if it's above 500, that goes to the reinsurer. So if somebody has $1 million claim, their A fund will respond to the first 125. Their B fund more than likely, or might just will also respond, but if it exceeds it, then the other members jump in. Anything above 500, it's going to go to the reinsurer. All right, so let me put some numbers to it, especially if we have any finance or accounting people. This will make a lot more sense. Hopefully it'll make sense to everybody. But to do that, let's start with and this is a little less than the average size member in this captive. But how do we get to their premium? Well, first we go to an actuary and he says, we need 385,000, which actually is going to be split. Most of that is going to be in the A fund to pay the small claims. We'll get to that. and then a smaller portion will be in the B fund. But to combine, it'll be 385 based on their 5-year history. Then from there, we add operating costs. In this example, operating costs are about 37% because I'm basing that off of this number. So everybody in the group is paying the same percentage, whatever that group percentage is, but that's going to cover the reinsurance for the insurance company to issue your policy for claims. So it's going to have a whole lot of different people, which when we get to a proposal stage, you'll see that. It's very transparent. You know exactly how much everybody's getting paid, but overall, it's a percentage that is similar. Everybody in the captive pays the same percent. So this example, we're saying roughly 60, what I say, 30, this one happens to be 37%. So we got 63% up here in the loss fund bucket. I can't make that take me too long to write that, but the 385 would be basically 63%. The other 37% is an overhead cost to get us to the premium of 611, 100%. And then there will be some broker fees below line. Most captives brokers can net out the fee, and there'll also be terrorism and other state charges. Again, when we get to a proposal stage, this will be very detailed out. It's very transparent. You guys own the company, so you know exactly where all your dollars are going. So we're going to use this 611, and then we're going to walk through a couple of different scenarios. Now, again, that operating costs, if it helps you understand it, a lot of times the captives are closer to 2/3 in loss funds. Those are the dollars they can get back if they don't have claims. That's the reward part. And if they do have claims, they might end up losing money or possibly paying in more. So I'll give you the good, the bad, and the ugly when we go through these examples. But this 226 is coming from the various service providers. So when I talk about service providers, the two biggest chunks are going to the carrier. So they're actually issuing the policy. In the case of Summit, which is this example, Old Republic is the paper. To the outside world, you're insured with Old Republic. When Eric and his crew put together certificates or auto ID cards, it doesn't say Summit, which is the name of the captive. It's going to say Old Republic. It's their paper. So they charge a fee, and so the other big fee is going to be down here on the reinsurance. And again, the reinsurer, if you remember right, is the guys that are taking any claim from 500 up to $1 million, unless the captive has gone to higher limits. In some cases, they're going up to 2 million. So they're the ones, they are taking risk, because if there's a big claim, then they got to show up and pay the higher end or the top of the claim. But you're also going to have claims, which is in this captive through Gallagher Bassett. We have a variety of risk control providers. Houseman does that too for their clients. They also play the broker role. And then, of course, we're the insurance consultant up here at the top. So again, of that, call it 37%, I think that we showed. Most of that's going to be in these two buckets, the fronter or carrier, and then the reinsurer. So still trying to get back to a couple of loss examples. And obviously, before we do that, I talked about the A fund having the majority of the money. Again, these are the numbers that the actuaries came up with after they looked at the 5-year history. So they look at each line, they come up with pricing behind the scenes for comp, auto, general liability. They all have a different rate, but then they combine them all together and they end up at 295 as far as what's there to pay small claims. So this is your A fund or frequency bucket. Any claim between 0 and 125 is coming out of here. In the event you have a claim that exceeds 125, then it pops up here to the B fund, which is there to pay any claim above 125 grand up to the group retention, which for this program is 500 grand. Much smaller bucket, And back to Eric's earlier point, this is all priced based on that member. They're looking at just their losses for the last 5 years. They switch gears when they price the B fund and they go back and look at the group activity in that layer between 125 and 500, and they come up with percentages. And those percentages are there to adequately fund the captive for any losses above 125 up to 500. So the percentages will differ by line of coverage, but when we get to a proposal stage, you'll see all the dollars behind the scenes as far as how they came up with the total amount. But if you add those two together, the A fund, the B fund, that's getting you back to that 385. Again, the other 220 something is operating costs. You're not getting those back. However, this 385, you have the opportunity to get back based on how good of a year you had. So that's what the next three slides or three examples show: a good year, a bad year, and then an ugly year, to what you want to try to avoid. Any questions so far, Eric, on just the concept? All right, so let's go through. This is hopefully what most of your years look like, either good or average. In this case, 165,000 of total claims. Let's just say you had two claims of 100 and one claim of 65. Well, individually, they're all less than 125, right? So this is all going to come out of this client's A fund, which is what the next slide gets into the accounting in terms of how much dividend would we be looking at once we get to paying out dividends. So in this example, their beginning balance was almost 300,000 in the A. We had these three claims that individually are all less than 125. They add up to 165. We still got a pretty nice balance of 130 left over. We didn't touch the B fund. I'll put an asterisk on that because this is the risk sharing bucket, right? But just to keep it simple, when we get time to dividend, if that B fund didn't get touched, which is never going to happen, you're going to have 130 left in your A, 90 in your B. And then don't forget, you have something called investment income, because we're not paying these dividends we don't start paying them till really 4 years out, and then they get completely paid 6 years out. So your money is compounding, the investment income is compounding. And if you looked at this 5 years out, it becomes a pretty significant dollar amount on the investment income side. So this member was paying over 600. They got roughly about a third of their money back by the time the dividends all showed up.
And to shed a little light on, that closeout period and, John alluding to the fact that those, distributions aren't made till further on, that's really there to let those claims mature, let them figure out how much the claim's actually going to be, closing those claims out when it comes to the full dollar amount, and making sure that nothing else pops back up from that year that wasn't reported at that time. And that's really why, when we talk about captives, it really is that long-term play from a stability standpoint.
And I've been around long enough to where captives weren't always so smart about how they paid those out. That they used to be almost too aggressive and try to pay them out too quick. And then they finally got smart and said, well, I mean, the last thing you want to have happen is you're paying out dividends 3 years out, and then you're paying too aggressively, and then you're going back to the member saying, hey, we overpaid. We need you to send some of that money back. So paying it out over like a 3-year window is pretty typical. And they try not to be too aggressive because they don't want to have to go back and say, hey, we overdid it. We paid you too much. We had some claim development. Again, that B fund, don't expect to see that 90 grand all come back. Even though that's your B fund amount, every year there's going to be, and typically we see somewhere between 5 to 7% of total premium that get eroded, mostly out of that B fund bucket, because they're much smaller dollars in there. And if somebody gets a big claim, everybody has to help out. So you'll see that on the very next slide. So now we're switching gears. We're going to we're going to still say, hey, they had three $50,000 claims, let's call it. Those are all going to come out of the A fund since they're all less than 125. But now we're going to add the Whopper, this $1 million catastrophic claim, which we know the member or the group is on the hook to pay the first 500 of it, right? Because the captive is only responsible for the first 500. The next 500 would get pushed to our reinsurance. So let's go through the model again. This time we got 150 in small claims, let's call it. Anything less than 125, that's coming out of this member's A fund. The first 125, again, the group is still responsible for 500, right? Well, we're going to grab the first 125 out of this member's A fund. So now we've almost wiped out this member's A bucket. It's down to 20 grand. Where things are a little more exciting is, okay, how do we make up the rest? Because this member only has 90 in its B fund. We grabbed 125, as you can see over here, out of the A. We're still short 375. Well, the first thing we're going to do is wipe out the member's B fund. It's not enough money, but that member is responsible first. So at this point, we've wiped out their B fund, right? We took all 90 out of their B. We're short 285. And actually, before we go to the other members and say, hey, help this member out, we are going to always take a look back to see if there's a positive amount in the A, which there is, 20 grand. So before we risk share that to all the other members, we are going to grab that 20 grand. And essentially then we risk share on a pro rata basis to all the other members the 265. At that point, this member has nothing left in their A or their B. They're not getting assessed any additional dollars, but we're short 265, and they're going to go to all the other members. In this program, there is like 300 members. So they look at each B fund as a percentage of the total available B, and whatever that percentage is their portion to help out this member to make up the 265.
John, one of the questions that came up is, where is the money held from each fund? Is it in the individual captive member's name? Does the captive overall have an account that's holding all of this? Who's overseeing those funds and making those payments?
Yeah, so great question. And all of that is done offshore. We have a sister company called Kensington Management Group. They're based in the Cayman Island. They keep us in check with our governing body because it's an insurance company. So the governing body in the Cayman is called the Cayman Monetary Authority. But they continue to monitor and track, like in terms of what's been paid out, what's going on with the investment. And the easiest way to kind of keep an eye on it is twice a year they redo the financials. So when we go to these board meetings twice a year, that's part of what you get is here's the latest financial statement. And oh, by the way, here's your own individual equity statement. So you can see year by year what's going on in terms of what your losses are, how much risk sharing did you get from other members, what kind of investment income did you get? It'll give you a scorecard basically every 6 months so you can track all of that. But it's all managed by Kensington Management Group, who's overseen by the Cayman Monetary Authority, which is a governing agency down in the Cayman. And then, of course, we do financials at the end of each year. Every captive has their own tax preparers, financial auditors. So we do all the same thing that the members that are on the phone call today do in terms of tracking all this. And all of that's discussed at length in the finance committee. That's basically their job, to keep track of what's going on with that world.
The other question too that was posed is, does that B fund carry over from year to year if there's unused money, or is it re-underwritten each year and then, starting from scratch?
Yeah, no, that's a great question. So I like to say every year is like firewall between the next. So every year stands on its own. You could have 3 great years, and then you have your fourth year that's lousy. They're not going to rob Peter to pay Paul. They're going to, if you owe money, extra money, or you have a 0 year with no dividends, that's going to stand on its own versus the other years you might be getting dividends back because you had banner years the first 3 years.
Yep.
Because so far, this example, neither one of obviously, the last example, a lot of money's coming back. This example, no money's coming back, or there could be some investment income that does come back, even though they have zero in their buckets, because this isn't tracking the investment income. So you could, the beauty of investment income is it takes a while before you have to actually pay the claims. And investment income, basically, you still get money if your claims are in reserves but haven't been paid out. So I've given you a good example. I've given you a bad example, or one where you basically don't have much in the way of dividends coming back. Here's what you got to avoid, worst case scenario. The last example. And I don't know, this has a little bit of a summary here where we basically, the majority of that loss was pushed to the reinsurance, no additional premiums. Your hand didn't get slapped or required to pay any additional money. The next example, you're going to have that. You're still getting investment income. And even when we go to price it next year, I think that was part of your question too, Eric. Every year, they're going to drop off your oldest year and add a new year. So they're always looking at a 5-year window every time they price you. They're going to re-go through the whole exercise every year. So here's what you try to avoid. This is the risk part of the captive, and that's high frequency, meaning a lot of claims that are all in that 0 to 125 range. So here we come up with whatever, let's say $400,000 claims and a 45 grand claim. All total 445,000. But the key here is that they're all less than 125. So that's going to only come out of this member's A fund. Well, guess what? As you can see, they don't have enough money. Now, here's where you don't get help from your friends. Because in this example, because it's frequency claims, this member's upside down 150 grand, and they're going to go back to that member and say, guess what? You owe us that money. So the captive is going to make you accountable, responsible, whatever you want to call it, for if you have claims that are all in that 0 to 125. They will give you a 3-year period to pay that back. So we'll show that coming up. But basically, in this example, they're gonna send an assessment for starting the next year, and they'll do it 3 years consecutively from there to pay up that 150. Now, in theory, you would still potentially get a dividend back because your B fund might minus some risk sharing. You'd have some money left over in the B, but you'd be paying in on this is the risk side of the captive. So again, that's kind of what this is showing. Potentially, you could still get some money back on that B fund, but you are going to have to pay the adjustment. How is that adjustment paid? This is that 3-year window that you have. So if in this example, if this member got hit with 150,000, they're going to grab 50% of that the following year, another 30% to get up to 80% at the end of year 3, and then the final 20% to get you to 100% by the end of year 4. And keep in mind, none of this stuff is static. The numbers are going to constantly change, which is why we do a financial every 6 months, because that 150 might become 160 or maybe 140. So they're going to constantly readjust those every 6 months based on what's going on with those claims. Nobody has asked maybe yet, but before they do, if I go back to the example, this isn't even worst case. Worst case would be we can assess a member up to twice their A fund. So how would that actually happen? Well, if you got an A fund of, let's call it 300,000, let's say you had $600,000 claims. Well, at that point, we would wipe out the 295. We would assess the member another 295. Anything additional then would get risk shared to the other members. But worst case scenario for this program, which is similar for most of ours, you can be assessed up to a second A fund. All right, so I went through the good, the bad, and the ugly. No questions on any of that, Eric?
Nope.
Because of that last scenario, well, first of all, there are financial requirements too. Most captives are going to require 36 initial capital investment. That's buying your common and your preferred share. Again, the preferred shares where all the dividends go. Common shares, your voting rights and any liabilities, assessments, paying your premium, audits, anything, collateral. So the 36 is typical. There are some captives that go to 25. EDIC actually is probably the lowest. It's at 10. But most of them are 36 go in capital. If you ever leave the program, once your oldest year is closed out, that 36 would come back along with any investment income. The bigger financial requirement is we do require collateral because of that last example. The frequency example, where somebody, what we want to avoid, and you can do letter of credit or cash, but what you want to avoid is for somebody to come in and let's say have 2 horrible years where they get maybe a partial assessment, a half an A or a double A, whatever it is, but then they say, wait a minute, this isn't working. I'm leaving the captive. I'm not paying those assessments for the next 3 years. The other members would have to make up that bad debt. So what they require is either letter of credit or cash. And it's primarily there just to make sure people are accountable on their losses. And it's basically calculated by the A fund. So whatever that A fund is, eventually they want you to get to 2 times your A fund, whether it's cash or letter of credit. If it's cash, you're going to get investment income just like your loss fund buckets, your A fund, your B fund. But again, it's there just for protection so the other members don't have to worry about paying for an assessment issue. They do let you, it's a stepped into process for like Summit. What they do is they grab 2/3 of your A fund. They do that 3 consecutive years. So you can see the individual numbers. By the time you get 3 years out, you're basically at 2A, or in this example, 590,000, whether that's cash or letter of credit. Now that would be for this particular member that's got a, call it almost a $300,000 A fund. So to reiterate some of this, if you haven't figured out, the A fund is kind of a critical thing. It's basically how the premium is decided, and it's the biggest chunk of your premium because that's the part that's there to figure out how much money they need to pay the small claims. But again, the pay-in premium is going to be the A, the B, and any overhead costs, whatever that group percentage is. Worst case, you can be assessed up to 2 times an A on any given year, which is that second bullet point. So you could have a lot of claims, but you do have sleep easy knowing that's the worst case. And then we do require collateral, which after 3 full years, generally that's where it levels off and it becomes parked to the side. It's just there in cash or letter of credit in case somebody doesn't pay their bills. The captive has a means to get that to be whole again.
A question came through about the blocking and tackling of the claims and how those are addressed. The one thing I will say about working with a captive on that front is your interaction with the captive is very, very similar to your interaction with your insurance carrier. If you remember in the slide where the overhead costs were shown when it comes to your total premium and the allocation of those to the reinsurance markets, underwriting, one of those was the TPA. So that's the third party administrator. Gallagher Bassett is the third party administrator in this example, and they're stepping in and acting exactly like the carrier. So you're going to have a claims adjuster that's assigned to your claim. Our team here at Houseman Group interacts with those adjusters in the same exact fashion as we would interact with the adjusters at any standard market. So the look and feel of the program is exactly same as the standard market. Really, the two biggest differences are one, you have a say in who those business partners are. If you're having a bad experience with your TPA and some of your other members are also experiencing that, you guys have the right to go out to RFP and look at other TPAs that could help adjust those claims that you feel they could do a better job. And then also it's the risk sharing portion, right? The fact of the matter is you could end up paying in a bit more if you're underperforming and having a rough year. It is maxed out, as John just said, at 2 times that A fund. But then on the flip side, very similar to workers' compensation in the state of Wisconsin, where you get a dividend, you now have access to earn back money on those good years, not only on your work comp, but also on your general liability, as well as on your auto lines. And then on top of that, you get to participate in the actual investment income and profit that the insurance company is making off of your premium.
Yeah, and I know Cassie's about ready to give me that 5 minute stick. So I'm going to jump ahead. This has got some information on the Captive Investors Fund and the 5 year results. So there's some other stuff in here. This would be the information we would need, or that you would work through Eric and his team, or anybody at Houseman. If you are looking at a captive, they're going to put together this on an Excel spreadsheet, 5 years of losses. They're going to want to look at policies. Even though we don't use the workers mod, the carriers still need that because technically it's treated like a traditional policy. They're still going to promulgate a mod. We just don't use it in our pricing. So if in the event you ever left the captive and went back to traditional, you'd still have a mod. We just don't care what our actuary doesn't look at it. He doesn't care what it is. And then most captives are going to require financials every year as well, just as part of the making sure everyone is paying their bills. It's just part of the requirements. This next slide, I'm not going to spend any time on because it's got way too much information. I think if you probably can't even read it, but this is something that we would put together once we get your information in, but it's pretty helpful tool because it can show what happens in a good year, a bad year, and an average year. And like in this example, this was a live prospect that was looking at close to 40% of their money coming back had they been in the captive the last 5 years. So we basically plugged in their actual expiring premium, went through actual losses, and we backed into captive numbers, but then we plugged in actual losses in our example, and that's not uncommon to see a third, or I've had cases where it's even been even more than 50% of their money has come back if they've had good loss experience. An easier one to look at, especially for you visual type folks, and this is most of the captives, and Summit does it, has an annual report where they'll show examples of, and these, believe me, these are not necessarily the best in the captive because I've got one in Summit that I like to use that has even better examples, but the same message where somebody's been in the captive. In this example, it looks like they looked at a example of a member going back to from 2014 to 2022. So about a 7-8 year window where their premium, the dark line, is showing their payroll, even though their payroll is kind of stayed flat. You can see the premium, the light blue line, how that's dipped down. On top of it, they're getting dividends. So if you factored in the dividends, this line would be even lower, but you're getting to much better premium dollars on this light blue line. You're getting dividends back, which is what this graph is showing. And if you were just to look at the comp in terms of what their rates have done, again, they started out when they joined at about a $10 rate per 100 of payroll. That's about half now in this 7 or 8 year window. So you
Yeah,
get to numbers you just don't see in the traditional market.
Yeah, and John, someone did have a question in regards to when they're setting those rates, how much of it's blended through the captive versus their specific exposures and their specific performance.
Well, again, go back to the three chunks of your premium: A fund, B fund, and operating costs. So the A fund is all about that individual member. They're only looking at the 5-year history of that member. So if that's doing well, then guess what? The A fund's coming down. Well, the B fund is a percentage of the A, and that's based on what's going on in the group. So that's a much smaller portion, but that's the part that you're more at the mercy of the group. And then obviously you got overhead costs. So you figure close to 40 to 50% of your money's in that A fund. That's all you driven by that member. They're going to take a percentage for B fund because every year somebody's going to have big B fund losses. Most years you're going to help the group. And guess what? Occasionally you're the bad apple where they got to help you out. But the B fund's there to protect you to get to that 500. And then the rest is overhead for paying the reinsurers and the claims and all the other service providers.
Yeah, and I know we're pushing up against time here. We're a little over. I think the main thing to get across on this concept and this chart too is one, we don't take moving to a captive lightly. We're doing all of that due diligence and the legwork ahead of time. And the biggest benefit that you're going to get if you are a best in class, high performing company with a commitment to safety, one, your safety is going to get better because those other members are pushing you as well. And you have more resources available to you through the captive. And at the end of the day, if you're partnered up with other best in class businesses, because not everyone can move into a captive, right? Versus being in a pool where you have any and every other business that's out there with not as much stringent attention to safety, your rates are going to be driven down. I mean, it is what we see across the board, and you may have those bad years. They do happen. But if you're committed to it and you're making that long-term jump into a captive, overall, we see our clients' rates dropping for that long-term period.
Thank you, Eric. And this is unfortunate. We'll have to cut the show short a little bit, but we want to say thank you so much for sticking around. We know we weren't able to get in detail on some of those last slides. So if you want to look at the copy of the PowerPoint and you have any questions, I will include Eric and John's contact information. Or if after the webinar you think of something after, you're welcome to email us as well. But again, thank you so much for joining us, for learning about captives. Thank you, Eric and John, for sharing your expertise. And thank you, everyone, for submitting your questions. It led to some really great discussions.
Thanks.
Take care, guys and gals.